Every month, millions open a bill for electricity, water, or gas and feel the same quiet shock. It looks like a simple charge. It is not. Hidden inside are layers of fees, pass-throughs, and adjustments that most customers never read. The real story is buried in the institutional design. Utilities are not ordinary businesses. In most places, they are protected monopolies, selling an essential service with no real competitor at the door. That monopoly is justified by regulation. But regulation can become a shield, and over time, a form of regulatory capture can quietly reshape the market. The battlefield is the rate case, where companies ask permission to raise prices. The public sees a hearing. The company sees a revenue target. At the center sits the rate base, the assets regulators let companies earn a return on. Once a cost enters that ledger, profit can follow for years. This means capital spending can be more valuable than efficiency. A bigger investment often means a bigger approved profit, even when maintenance would have been cheaper. That creates a structural flaw. Companies may have less incentive to repair old infrastructure if new construction grows the regulated asset base faster. Commercial customers face another layer of hidden economics, demand charges. One burst of power at the wrong time can reshape the whole bill. Residential customers are pushed toward time-of-use pricing, smart meters, and dynamic rates. The promise is efficiency. The reality is often bill volatility. When prices shift by hour, families become unpaid managers of a complex market. They are told to adapt, even when their lives cannot. Then come the pass-through clauses. Fuel costs, purchased power, and environmental surcharges are often transferred directly to customers with little negotiation. This is how hidden ledgers work. The base rate looks fixed, but the rest of the bill becomes a moving target that customers struggle to audit. Even before usage, many customers are billed for simply existing on the network. Service charges, meter fees, and delivery fees stack up before a single kilowatt is consumed. For low-income households, the system becomes punitive. A missed payment can trigger late fees, reconnection fees, and a cascade that turns inconvenience into crisis. Disconnect policies reveal the power imbalance. Essential services are non-optional, yet access can be cut off through bureaucratic rules designed to enforce payment discipline. Prepaid meters intensify that pressure. They shift financial risk from the utility to the household, making interruption immediate and cash flow management brutally personal. Water systems have their own hidden economics. Pipes, treatment plants, and long replacement cycles create enormous capital needs, which regulators eventually funnel into rates. Because infrastructure is so expensive, utilities borrow heavily. Debt becomes part of the machine, and interest payments are quietly embedded in future bills. The profit margin is not always obvious, but it is real. Utilities can earn regulated returns on equity while financing operations with customer payments and borrowed money. That structure protects shareholders. Consumers absorb the uncertainty, while the company seeks steady recovery of costs and a predictable return on capital. Distributed energy was supposed to break the model. But net metering battles show how legacy utilities defend revenue by challenging rooftop solar credits. The fight is not just technical. It is political, with lobbyists arguing that every customer who generates power must still pay for the grid. That argument is not always false. A grid needs backup, maintenance, and balancing. But the debate often masks a deeper struggle over who pays for transition costs. After storms, fires, or droughts, recovery charges arrive fast. Disaster becomes a line item, and the public is asked to finance resilience after the damage. In some regions, utilities have shifted catastrophic liability into special funds or future rates. That decision socializes risk while preserving the company itself. Deferred costs are another quiet mechanism. Expenses today are parked in the future, where they can be recovered slowly through bills that keep arriving. That delay hides the pain. What looks manageable this quarter becomes heavier next year, especially when rate approvals lag behind accumulated spending. Customer service often acts like a maze, not support. Long holds, confusing classifications, and opaque explanations protect the institution from direct accountability. Automation lowers operating costs, but not always the bill. Fewer staff can mean greater efficiency for the company and worse outcomes for the customer. The affordability crisis is not an accident. It is the outcome of an institutional design that prioritizes cost recovery, capital spending, and rate stability. For poorer households, the burden is regressive. The same essential service can consume a far larger share of income, turning utilities into silent inequality engines. This is why reform is so difficult. The system is layered with statutes, commissions, lobbyists, and technical language that most citizens never get time to decode. Once you trace the connections, the pattern is clear. Hidden fees, monopoly pricing, and regulatory capture are not bugs. They are features of the model. The utility bill is more than a statement of use. It is a map of power, a record of hidden economics, and a window into who carries the risk. Follow the charges, follow the filings, and the story reveals itself. Essential services were built to look simple, but the ledger tells a different truth. Subscribe for more.